All right, good morning, everybody. Welcome to the MarketSmith Advanced webinar. And today we are going to be talking about head and shoulders patterns. Quick introduction here. My name is Arusha Pierce. I'm one of the product coaches at MarketSmith. And with me today, we have a special guest too, Matty I like to call him. And he's going to be participating and giving his thoughts on the head and shoulders throughout the presentation. So the agenda for today, we're going to be talking about both head and shoulders and actually also the inverse head and shoulders too. And we'll go over a number of examples for each one. Before we get started though, let's just make sure we're all clear on the webinar software functionality. It's located in the top right hand side of your computer. And whenever you have a question, just type it in during the presentation, okay? You don't have to wait till the end of the presentation, and we will make sure to answer it by the end of the presentation. Now, it's people hearing me. I hear that someone's hearing no sound, but okay, I think everyone else is hearing. So Jason, maybe restart the, oh, you can't hear it. Never mind. Well, we'll keep going on here. Okay, a disclaimer, this is all, please take this all as educational purposes only, and please don't take it as buy or sell recommendations. And so let's get right into the head and shoulders. And so generally, head and shoulders are reversal patterns. That you'll sometimes see them as continuation patterns, but for the most part, they are known as the reversal patterns. And in fact, they are generally the most popular chart pattern that you're gonna see around. You know, CNBC, all the financial TV stations, they talk about head and shoulders pattern all the time. Now, here's the key: a lot of times you're gonna see a pattern start to develop, but it's not really valid until you see that confirmation. And that confirmation is once it breaks the neckline. So I want you to keep that in mind during this presentation, because that's the key. Everyone can, it's so easy to anticipate that the stock's going to go down because it's forming it, but it's only really in trouble once it has that confirmation of breaking the trend line. So let's just go over how a head and shoulders looks right here. And so here's a line chart, and so here's the left shoulder and the head that we've highlighted here. Now, one thing that I want to point out is, you know, while the stock is formed the head of a head and shoulders pattern, it's completely fine. You're actually in an uptrend here. So in real time, you don't know that this is actually forming a head and shoulders. It's actually after, once the stock comes down and it starts to correct a little bit, and now it doesn't find any more buyers at this point to push it higher and continue that uptrend. That's where it really starts to form the pattern. And now the neckline that I was talking about, this is really what it is. Really what the neckline is, it's the support area. Okay, so when you're going, if you want to get really basic on all of this, it's support and resistance. Here's a stock, it's testing a key support area, and of course, once it breaks it, that's where you get the confirmation. Okay, so just take a snapshot of this and really try to understand the larger concept of this. You're having a stock that was in an uptrend, now it started to go through a normal kind of correction, and all of a sudden it started to run out of buyers at this point. And a lot of times it's right near the top of it.
Yeah, you know, Arusha, I guess I should say good morning to everybody, and thanks for having me on, Arusha. You know, one of the things that Arusha and I work very closely on, I mean, we sit right next to each other in the cubicle, so a lot of times we'll be kind of throwing stock ideas back and forth, looking at different patterns. And, you know, one of the things we try to work on is, you know, our chart recognition is one thing, but also trying to understand what the chart is telling us, because one of the things we generally find is that when you get too fixated on the chart pattern itself and trying to guess, you know, an entry point or trying to figure out what stage base it is, you know, sometimes you kind of miss the overall I guess the message that the price formation is actually showing you. And really it's not that prices move because of a chart pattern. The prices actually move to create the chart pattern. So when you understand sort of how the prices are moving and why they're moving a certain way, it definitely helps to understand why certain things are reversal patterns or why they're bullish patterns. And to me, one of the ways that I like to look at head and shoulders, and you know, Arusha will kind of show this in a bit, the inverse or the reverse head and shoulders, is essentially when you look at this neckline, what a lot of times will happen is there will be a really big mutual fund or maybe several mutual funds that might be looking at a stock that they want to buy, and they say, you know what, buy me everything that you have from $34 to $35. So every time the stock goes up to, maybe 36, 37, then it comes back to 34, 35. All these buyers are there waiting to buy it. So what will happen then is a lot of shorter-term traders will say, okay, we've got a good floor of support here. Let's see if we can push this thing higher because we know that there's somebody big in here wanting to buy it at this price. So they'll push it up higher, and then some sellers will come in, and it'll fall back down to that original price. And again, some of the traders, the shorter-term traders will say, hey, let's go in there. There was a big buyer in here last time. We'll push it up. All of a sudden, the sellers are starting to overpower the buyers. And essentially what Arusha is saying is on this break of the neckline, that means that that big buyer that everybody was kind of relying on to prop the stock up is no longer there, and that's troublesome. That means that somebody out there no longer wants to pay the price that they've been paying over the last several weeks or months, and that's what makes the break of the neckline really so important and key. And like Arusha was saying, you don't want to start looking at it from a shorting standpoint, or if you're long trying to sell it as it's forming the right shoulder, because we never know if it's going to break the actual neckline. I mean, if this just traded right back up to the head area, back down to the neckline, back up to the head area, now you've just got one big old consolidation. So you don't want to jump the gun, and that's important that Arusha was mentioning that.
Yeah, and to go off that go into that a little further. If we're looking at this from a trend perspective too, earlier I mentioned here was an uptrend, right? You're making higher highs here. At this point, you're starting to make lower lows once you break that neckline. Okay, so if you want to really get down to the basics, that's what this is doing. You're starting a downtrend here, and this is your confirmation of a downtrend. Okay, so let's get into the volume part of a Head and Shoulder, because that's also important too. Now, throughout the presentation, we're going to be labeling a lot of these examples as LS, H, and RS. Okay, just make sure you know that those are left shoulder, head, and right shoulder. And during an uptrend, a lot of times when the stock gets going, you start seeing heavy volume as the stock rises. This is exactly what you want to see in a stock that you're in, right? Now, eventually, once the stock starts getting up a little bit in higher levels, you're going to have less buyers at that point willing to pay that price. And so the volume will slowly decrease, but it's still going to be pretty normal. Now, here is one of the key indications that maybe the stock is running into a little bit more trouble. At this point before, where you had heavy volume, now you're starting to have more lighter volume. So Matt was talking about this with having that big buyer around the support area. All of a sudden, that big buyer is no longer there, right? And that's reflected in the light volume. And then finally, once it breaks the neckline, you want to see heavy volume coming in. So now you're starting to see more sellers starting to overwhelm the buyers and really confirm as it's breaking support. Okay, so those are a few things to keep in mind while we go through these examples. So let's go over the first example, and this is Aruba Networks. And as you can see, a super long uptrend right here, right? Very, very powerful. And this stock went from $2 up to $36 or something like that, right? So immediately, and so most of us here, we're all pretty familiar with the CAN SLIM system, so we already know that this is probably a later stage base getting around anyways. And so it's probably getting a little bit more tired. And so now, while a lot of these stocks, when they start getting tired, once they start distribution, you will start seeing this head and shoulders pattern. And so here it is on the chart. Stocks going up. It forms a consolidation here, breaks out of this consolidation, forms a higher high. And now when it comes back in and tests that support area or this neckline, now it starts to run out of buyers at this point, and now starts to come back down and break it.
Yeah, on this one too, Arusha, one of the things that, when you start doing this for any length of time, you'll start to notice that a lot of different indicators or signs will start to converge on themselves. Because even though we're seeing a head and shoulders with a potential break at this point, if you've been doing this as far as a looking at it from a pure technical standpoint, you're going to start to notice that you have a really bad break of the 50-day on heavy volume. That's your first negative sign. Second negative sign is, what do we have here? We've got 1, 2, 3, 4. So this is a fifth stage base that was trying to form, right? It sold off, formed the right side, could never break out. So there's, it's just another negative sign. And so one of the things you'll find is that at the tops, and that's kind of what a Head and Shoulders is really trying to signify is a reversal of the major trend up or down. You'll start to see a convergence of a lot of these different sell signals. You've never been able to breach 200 the whole way up, and all of a sudden now you're spending a couple of weeks below it. Try to get above it, can't do it. Come back down under it. Really the 50-day has never tilted down. It's kind of stalled out a little bit. Gone up, kind of gone flat, gone up, flat, up. Now it's rolling over. So all of these things are starting to happen at the same point, and a Head and Shoulders is just kind of, another cherry on top. So, when you study technical analysis, when you study chart patterns, a lot of these things start to all happen at the same time, and it's all basically the same thing. It's telling you the same thing. There's more sellers than there are buyers. If you're long it might be a good place to take some profit. If you're super uber aggressive, maybe you nibble at a short position, but unless you've really made a lot of headway on the long side, most of us here we don't really dabble on the short side. It's just a lot more difficult.
Yeah, no, I definitely agree with that. And Matt, you pointed out a nice thing here with the volume increasing, coming back down, bouncing up on lighter volume, and then the volume's increasing again. And so here's the results of it breaking. Now, here I like this example because this is classic with just trading in general, right? You break this, and actually this went down a little bit for a while, but look how it snapped back too, right? And I'm sure for those of you who've been doing this for a little while, trading is not nice and clean. It's very messy, right? It's never going to be a perfect kind of thing. And so you break that support, and here you come back, rallying right back up in this kind of V-shaped rally, right back up to test and to see if that support is really resistance now. And it's amazing at how when you start looking at it from this kind of perspective, how often you'll see stocks doing this over and over again. They're just testing these levels again and again. So that was a critical break, but they're not going to always go straight down. And in fact, if you really thought that Aruba Networks was going to be a great short, and you had initial reward, but then after that, you had to wait a good 3 months before you started to really see it drop even lower.
Yeah, I think not even 3 months. That's like 3 quarters, right?
Three quarters, yeah.
And that's another thing is, when you're trading, you always have to think about the time value of your money. Yes, you could be right on the trade, but it might take, 6, 9, 12 months, 18 months for the trade to play out the way that you thought. And while you may have potentially made 30 or 40% on the trade, being as though you're quote unquote right, heck, you could have made like 10, 20% trades or 10, 15% trades in that time. So just kind of keep that in mind. And that actually parlays into the next question that we have here. Do you use weekly, daily timeframes or hourly timeframes for the Head and Shoulders? And my answer to that is I think you could use any of them. It's just your expectations have to change in line with the time frame you use. If you're doing an hourly Head and Shoulders reversal, then expect the move to be just a retracement on the hourly charts. If you're doing it a daily, it might retrace or go down further based on the daily. But, when you start looking at it from a weekly or a monthly standpoint, that's where the time frame for the correction or the time frame for the top is going to be a much longer term correction. I mean, that's essentially the way I'd look at it is depending on whatever time frame you're in, that's kind of sort of where you want to keep your expectations in line. Don't think that a Head and Shoulders on an hourly is going to lead to an 80% drop in the stock. It doesn't work like that. They have to take more time on the chart to kind of work through all the buyers and sellers.
Yeah, no, definitely keep that in perspective. And actually, that a lot of times when Matt and I will look at a lot of stocks, we're switching from daily, weekly to monthly, right? To really get and say, okay, how significant is this break or breakout? Right? A lot of times on a weekly chart, you may get a great breakout, but if you look at a monthly, it might just be a breakout and you're getting closer to a more significant resistance area. So you definitely should be looking at all these time frames to really keep that in perspective right there. So let's go to the next example. And this is Deckers back in end of 2011. And once again, gone on this huge run, later stage base. And so here are the left shoulder, the head, and the right shoulder. Okay, so once again, it starts running in trouble. You had a pretty decent uptrend, then you start seeing it get hit on big volume, coming back up, and the volume started to run out a little bit here. Now you see the volume increase a little bit more. Okay, so some of these stocks, once again, this pattern took a while to complete, and so if you were in a rush to get into it, and you immediately expected that reward, you're probably going to be shaken out of it. All right, and so here is the neckline. Once again, that key support area. And when it breaks, there's a little bit more of a clean break right here. Take a look at that huge volume coming through. So this is a little bit more of a picture perfect. A lot of times this is going to happen on an earnings report too, right? The stock will completely set up a pattern, and everyone's kind of waiting for that new information to come out of the market. They disappoint, all of a sudden you have a lot of people exiting the stock, and you get that big volume.
Yeah, and there's a question coming in. Well, how do we know that this wasn't the head, this wasn't the head, or this wasn't the head? That which one was it? And like Arusha was saying, it's never clean, it's never easy. But even though in hindsight, it looks like, oh yeah, there's clearly this is the left shoulder. To me, I actually almost think of it, in totality as this whole area is a left shoulder, because when you kind of think about this, and again, this is just trying to understand what the chart is telling you and not necessarily relying on the pattern per se, but it's basically saying that there's somebody in here who thinks it's a pretty good value at about $80, and each time they keep trying to test higher highs, and it's kind of what I call a reluctant high. It goes higher for just a little bit, then comes back down to where those buyers were at originally, and then finally, after it tries to go again, it has a actually really sharp breakdown to this 80 level again. It's almost like everybody's like, okay, finally it's all clear, let's push it up. And all of a sudden it hits 120 and say, oh, nope, there's sellers there still. Let's see if that buyer was still there at 80. Yep, he is. And now all of a sudden they run into sellers at 100 again. And then they're like, you know what, this is done. It's the buyers out there were not willing to pay higher than $120 for it. And then the second attempt up, they weren't willing to pay more than $100 for it. So somebody out there does not think that this is worth, more than $100 at this time. And, it's only a matter of time. You keep knocking on that door, you're going to get let through eventually. So that's kind of one of the things you want to look at. But again, don't get too fixated on this. This really can only be done in hindsight after, you look at the full chart. As it's occurring in real time, all of these areas right here, you're trying to figure out where the buyers and sellers are at, and that's exactly what the head and shoulders pattern is a completion of, sort of showing where the buyers and sellers think a stock is worth at any given time.
All right, and one other thing to point out here, note how once it broke that neckline, how Deckers couldn't even get back above the 10-week line. And they just kept selling it at this point. So it was really interesting at how this 10-week line just kept pushing the stock down. So this is a big reason why we're really paying attention to that 10-week line, because once it starts getting underneath there, a lot of times you're not going to have that support that it used to have. All right, a third example here, F5 Networks. Once again, really strong move up. Everyone was talking about it back then, right? And so now here is here once again you have the left shoulder coming back down, goes into new highs, comes back down. Now here, this break right here, that's almost the classic one. And actually in real time, a lot of times if you see that on an earnings report, it's a big gap down, huge volume. You want to be thinking, hey, maybe this is going to form some kind of head and shoulders, or this very well this is a significant top. And if that's going to be a really big time resistance at that point. So here it gets hit on huge volume, comes back up on lower volume, and now comes and tests that support. And so here's that neckline. It breaks it. And this one, once again, like a couple examples ago, It took a little while for it to really tested everyone out here. There are a lot of there are a number of buyers here probably trying to get more of a value type of buy here, and they're just trying to push it up. And Bill O'Neill in it, How to Make Money Selling Stocks Short talks about how he likes to see stocks test the 10-week line a few times before considering getting into it. And the reason why is because a lot of times there's a churning process right here. And you're having this battle back and forth, and if you try too early, you're going to get whipped around. This is a classic area where you're just going to get frustrated and whipped around, and you'll finally give up, and then you get that break. And notice that how, gosh, what a frustrating stock. It came back immediately, right back up again, and really frustrated all the shorts at that point. But the key thing here was, once again, once it broke that support area, it turned in resistance, and then finally eventually sold off here. And one other example for the Head and Shoulders, this is Open Table back in 2011. You get your neckline and you get your break, and this is a little bit cleaner break at this point. And this one actually worked really well. Now, a lot of times when we talk about shorting, and I did a webinar a couple of years ago now, I guess. Bill O'Neill usually says if you get your 20% on that, take it. And you're not going for these huge winners because the shorting is a lot harder. And it almost seems like once you start getting up, that short covering rally is right around the corner. Some great news is going to come out, and they're going to force everyone to cover at that point. This one worked pretty well though. Now, Matt was talking earlier about the Deckers example about the complex Head and Shoulders, where there are multiple Head and Shoulders. Here's another example of that. This is Cena, and so talking about messy right here. Here are a few Head and Shoulders where it kept testing, kept whipping people around, and then it finally broke through the neckline and eventually worked. Okay, but the larger concept is that you had a major buyers and sellers were kind of going back and forth here for a while. Some of these institutions, they have millions of shares. They need some time to sell them. And they're going to try to do it as quietly as possible because they don't want to blow up the stock. They have a lot of shares there, right? So they'll sell a little bit, let it rally up, come up a little bit more, sell a little bit more, right? And that may take a good half year or even longer.
Yeah, and this is really, just like the Deckers example, this is a good example, in my opinion, of trying to understand the buyers and the sellers, what they're thinking at any given point in time, and how their thought process and, more importantly, their actions are being displayed on the chart versus just focusing on a chart pattern per se. Because, if you look at this from a pure chart pattern standpoint, this isn't a Head and Shoulders. It's way too messy. It's not a clean one. But when you think of sort of the thought process of what the sell-offs represent, what the rally backs represent, what the series of lower highs represents, it represents everything that a Head and Shoulders does. It basically represents prices that can no longer exceed the prices that were there 2-3 weeks ago, 2-3 months ago. And it still represents the fact that it keeps coming down to a certain area where it has gotten support in the past. And it's kind of like every time you get down to that area, it becomes much more critical. It's like, which one of these is going to break. And so from that standpoint, it's very much a Head and Shoulders. So it's, really I think chart interpretation and chart pattern reading is a lot about sort of what's the intent of the law, not the letter of the law, So that's to me the biggest thing about learning how to read these,
Yeah, I absolutely agree. A lot of this is more conceptual. It's not an easy black and white kind of thing, especially with trading. A lot of times it just takes time, especially if you're looking on a weekly chart. You got to keep in that time frame. It took a couple of years for the stock to go up in a nice trend. It may take a while for it to complete a larger, more significant pattern for it to actually go down. So let's go to the inverse Head and Shoulders, and we'll move a little bit more quickly on this since we're starting to run out of time here. But inverse Head and Shoulders, just the exact opposite. This is a reversal pattern off the bottom. And it's where the head of the pattern, that's your key shakeout area. Okay, you're going to shake out all of the weak holders. They're all going to give up on the stock, and then a little while later, it'll form a right shoulder, break through that neckline, and now it has a chance to really work. So here is the example. Left shoulder right here, and I'll take a head and the right shoulder, and then there's your resistance area or your neckline. Then you get your break, okay, and that's the ideal kind of entry point. So here's one example. Infosys back in 2009 comes down pretty hard. It's not the nicest, neatest one. Comes back down pretty hard. You have a shakeout. Then you have another kind of test down to that lows. There are no more sellers there. Forms a neckline, breaks through, and now notice that how it's actually able to start that uptrend up. Okay, so once again, this is you have a downtrend, lower lows. It's more a trading range right here, and once you start breaking that, now you start having your higher highs.
Yep, and just like it occurred on the upside, you see it right here on the downside. You know, if you do this for a while, you will see a lot of different like thought process or different ways of looking at the stock market start to converge. You know, here we've got an inverse head and shoulders, but what do you have in here? You also have, looks like a cup and handle or the start of an ascending base. The stock is starting to trade above the 50-day moving average. You've got a 50-day moving average crossing over the 200-day, right? All of these things are things you hear about. You know, we don't necessarily talk about them all, but they all represent the same thing. On a conceptual level, it's that buyers are overpowering the sellers, and that's what causes a reversal in a trend. And so when you learn to think of chart patterns more in conceptual terms and try to understand what the chart pattern is actually telling you about the exchange between the buyers and the sellers, that's where I think you can take a step back and let the chart tell you a story rather than getting fixated on the chart pattern itself. And a lot of times those chart patterns have a lot of noise, a lot of whipsaw, and people get frustrated trying to follow the chart pattern when really the overall concept of the chart pattern is the noise is well within the tolerance range for what the overall concept is. So again, it's just one of those things to consider. Take a step back. That's why a lot of us here like to use weeklies, monthlies. It just helps to kind of give you that bigger perspective on what's going on.
All right, next example, and here's CALD, and once again, it had a nice downtrend here, pretty vicious. You form your left shoulder head, and then the right shoulder is a little bit cleaner. Now, you have multiple right shoulders here, too, and there's your clear resistance area. You know, we could always debate whether this is a head and shoulders and things like that, but I think we can all agree that that is a pretty significant resistance area at this point. And then once it breaks through, it's able to actually start a new uptrend. Here's Digital Globe, another one that's pretty clear right here, where you're just testing, shaking out people at the head, and now look at that volume coming in. Settles down in a trading range, and you form your right shoulder. There's your resistance area once again, and take a look at that really strong breakout right there, overpowering. Matt said buyers overpowering, right? And that a lot of times that's the key. All of a sudden you have all these buyers like, yeah, we're in, we're committed, and that's what gives it the ability for the stock to begin that new uptrend. So there's one last thing that we want to go over for this webinar right here, and this is the head and shoulders potential move. And a lot of times, the way technical analysts will look at a chart, they see a pattern like this. They want to try to get an idea of, okay, how potentially far could this go, to just put in a little bit more perspective. And so the way that technical analysts will do this is with a head and shoulders is that they'll measure the distance from the head and the neckline, and say, okay, this is the potential move, and they'll subtract it from the neckline, and that's where they'll get their target. So to illustrate this with a chart right here, here's your head and shoulders pattern. And so what they'll do is they'll take the head and the neckline, and they'll calculate that difference from the head and the neckline and get a value, and then they'll just subtract it from the neckline and say, okay, here's your potential target. Now, obviously, it's not going to exactly hit it. Sometimes they'll fall short. Sometimes they'll actually go further than that. But it gives them an idea of how significant this pattern is. And so now they can come up with a game plan to see if it's worth taking or not. Okay, so here is Deckers again, and going through that long head and shoulders. And so what you want to do for this, if you want to get a potential move, is measure the head and the neckline. And so you get that value there, and all you do is just subtract it from the neckline there. And so there's your potential point. So you can see that this one went a little bit further, but at least it gave you an idea that, yeah, this spent a lot of time here. And once it broke, that was really significant. And so the potential target was the difference between the head and the neckline.
Yeah, I was going to say, somebody was asking if this applies to market indices as well. I say this completely does, whether it's the NASDAQ, the S&P, whether you're trading crude oil or corn futures. What you're really doing is just looking at price and volume, right? Buyers and sellers. So anything that involves two parties transacting something at a price, you could essentially say that price formations happen there as well. I mean, that's all it is, and that's why it's so important to kind of understand that, that concept of what is the price pattern forming, or what is it trying to tell me, versus trying to figure out, oh, is it a flat base, or is it a double bottom, or is it a failed cup and handle? To me, the story that it tells is much more important than trying to focus in on the minutia. And trying to figure that stuff out. Bigger picture is always better.
Yeah, and also to go off of that it's risk management too, right? When you look at these patterns, even if we just use a cup of the handle, with a cup of the handle, we know that a great stock breaking on a cup of the handle, on average, has a chance to go up 20 to 25%, and your risk is 7 to 8%, right? That's your 3-to-1 reward risk ratio. Much in the same way here, where you measure the technical analysts will know and say, you know what, our potential reward is this value, and so our risk is it coming back above that resistance area now once it breaks that neckline. So you can adjust, and in my opinion, as long as you have that risk reward management and you're managing that risk, that's the bigger key. So let's go over another example right here, and here's CLD again. And so you're measuring the neck to the headline. I mean, the head to the neck. Did I actually say that, Matt?
Yes, you did.
The head to the neckline right there. And then here's your potential target. Now, obviously, this went up much further than that, right? But it gave you, this was enough to say, for those to say, our reward is this, our risk is this many points, it's worth taking.
Yeah, I was actually going to say that, again, I always like to take a look at sort of the bigger picture. And, in essence, this is kind of in a really big trading range here, right? And when you kind of draw it like that, it's, if you enter it right here, even though your target is only a little bit higher, that's kind of getting you at least into the area where you may encounter some more resistance. So while the average person might get chopped out trying to buy it in this area, you've got a lot of cushion now to try and just give it some room to do its thing as it encounters and tries to figure out what it's going to do at that next resistance area, the next place where buyers could not overpower sellers in the past. And, to me, this is very classic. I mean, look, this head and shoulders, inverted head and shoulders, forms right at the lows of the last pullback that had occurred. And again, like Arush said, it's not going to stop to the tick or to the penny. It's going to overshoot a little bit, but the general vicinity of $4, somebody's buying it. And by the way, that $4 extends all the way back into the past. Just in general, somebody was selling it anytime it got above $3.50. So all of these things start to converge, and they all become the same sort of point of view. But to me, that's why it's more important to understand the concept than to key in on the minutia of, oh, okay, is this a cup and handle, or is this a technically a head and shoulders? The left side didn't come down as far as the right side, or whatever it might be. Try not to get too caught up in the minutia. Try and look at the bigger picture and what is that chart telling you.
All right, it looks like Glenn has a question here. The entry point with CLD, it's really where you're breaking the neckline for this. So anytime it breaks the neckline on good volume, that's your entry point. And that's how a technical analyst will use the head and shoulders to start a trade. Okay, so that's it. All right, so let's put it into practice and recap here. So hopefully this was helpful for all of you, and I definitely think it's worth it to go and study this pattern. It's really interesting, even just from a price and volume perspective, to go and see how these things form. You'll get a lot out of it, even if you're not necessarily using it. Do I use it that much? Not really. But looking at it from a conceptual point where you just start seeing the volume dry up, all of a sudden there are no more buyers. Now you see a lot of sellers coming in. That's what you really want to get. Those are the larger, more important concepts. Now remember, the break of neckline on huge volume is key. Just like a break in a chart pattern that we study, volume is key. And once again, price and volume really does tell all. It doesn't, like Matt has said, it does not matter what the pattern is. If you understand the price and volume and how that the reaction and how those two interchange with each other, right, to get the insight from that price and volume, that's the most important point.
Yeah, I think that kind of wraps it up for the formal presentation. We do have a couple of questions coming in. I think it would be kind of helpful for everyone to go through it together. One person was asking for inverse head and shoulders. If the RS is only 40, would you buy it? And again, before I make an answer to that, just kind of keep in mind everything is just illustrative and for educational purposes. So don't go out and buy something just because I say that it's okay or whatnot. But in my mind, I would buy it. And the reason I would buy it is, when you study a lot of stocks at the lows, well, they're at the lows. The RS is going to be really bad, right? And when you look at stocks that are reversing off the highs, well, the RS is going to be pretty good. It might be like like an 89 or a 93, and then it forms that head and shoulders, and boom, it breaks through and it's done. The classic example I tell people is Apple had an RS of 55 in its first stage base September 2004. And that's kind of, to me, I really do like the Growth 250 because it allows those situations to filter through into my screens and my watch lists. But that's something that Mike Webster, Scott Latonen, and myself, we worked very hard on, is to say, hey, even though a stock has a low RS, if it's clearing some kind of resistance or it's breaking out, we don't want to neglect that. It could be the very first base of a very big move. Now, the odds of that are, diminished versus maybe a stock that's pushing all-time highs. But to me, you still want to be able to spot that first stage breakout and at least have it on your plate so that you can look through it and see if the risk-reward is worth it. But, to me, I don't know, maybe, Arusha, you have a different answer. But to me, yeah, even though the RS is 40, when you break that inverted head and shoulders, the buyers are overpowering the sellers, and that's the kind of trade I'd like to be in.
Yeah, I generally, for me, it's not I would look at everything, right? So the RS being only a 40, it wouldn't automatically eliminate it for me, but it'd be a huge negative. So it better have that many more positives to overcome that huge negative. Matt used the Apple example back in March 2004 where it was a 54 RS rating. Yeah, that was a huge negative right there. But if you look, they had a great new product, the iPod. Huge earnings and sales.
3/4 of triple digits.
3/4 of triple digits, exactly. So they had all of these positives to overcome that major negative. So you're always weighing the pros and cons for that. So it's not really, if it's just an RS of 40, then you buy it at that point. You're always looking at everything. And of course, you're managing your risk too. If you're going to try something like that, you have to know what your risk is, and a lot of times you're going to be stopped out.
Yeah, I was actually going to say it's a good point. One of our moderators was bringing up a good point. Stocks don't go up because of chart patterns. What really happens, the whole process of how stocks move up or down, is you've got all these funds with their hundreds of billions of dollars, trillions of dollars in assets under management. They employ thousands on thousands of CFA analysts, people, who work out in the field and basically track all the metrics of these different companies that they potentially might buy or have a position in. And what all of these analysts report back to the main portfolio managers is, hey, here's what we see. There's about, on average, 50 people exiting an Apple store every hour. And on average, the average receipt is, $200 or $300 or whatever it is. So let's multiply that out until the next quarter. Here's what we think the earnings are going to be. Here's where we think the revenues are going to be based on what our, analysis is telling us. We've talked to the distributors. Apple is ramping up inventory. It's likely they're expecting higher sales. So all of this is leading the portfolio manager to say, okay, we need to start buying more Apple, And what happens is over time, that buying is going to be reflected in the chart. And that's what forms the left shoulder, on an inverted head and shoulder, the left shoulder, the head, the head, and then the right shoulder. And by the time they're doing all this buying, they still may see value in the stock, even though it's going through the neckline. They'll continue buying all the way up. And so it's not necessarily that stocks go up because of the chart pattern. It's because they're going up because there's overwhelming buyers. And the reason there's overwhelming buyers is because fund managers collectively see more value in the stock at a future point in time. So it's a good point what our moderator brought up, that the earnings and the revenues are drivers of the price movement, and the chart pattern, the technical analysis, that's just the footprint of the big funds.
Yeah, it looks like, okay, we have time for one more question here. It looks like someone asked, what's a CFA? If you have any questions about CFA, contact Scott Latonin. You just passed all 3 CFA
congratulations
right
to our product coach over
so
there.
He'd be happy to talk all about the CFA with you guys and maybe even coach you guys just on the CFA. So you contact him directly. Let's give the contact information for the rest of us here. 1-800-424-9033. Send us an email at reachus@marksmith.com. And also, we are on Facebook and Twitter. There's information for that. And thank you all for joining us. It looks like we have gone over time here, but it's been good. So thanks, Matt, for being the special guest and adding a lot of value on this webinar. And any questions, please contact us. If not, we will see you next week.